Hello, everyone. My name is Nick Nash. I'm one of the 6 co-founders of Asia Partners, and it's my pleasure to welcome you to the video version of our 2022 Southeast Asia Internet Report. Before we get started, though, I just want to highlight and emphasize the fact that although we'll be talking about many reasons for optimism and many very positive developments that have taken place in the technology sector in Southeast Asia and beyond, the much more important narrative, the much more important set of facts remains the ongoing COVID-19 pandemic taking place on a global basis and right here at home in Southeast Asia. Our deepest and most sincere condolences go out to everyone who has lost family members, loved ones, friends, and colleagues to the tragedy of the pandemic. And in parallel, our greatest appreciation and respect goes to every one of the healthcare and public health professionals that have worked so hard and sacrificed so much to keep us safe. You are truly the heroes of the last 2 years. Thank you so much. What we'll be talking about today, in some ways, is a continuation of work that we've been doing for several years. We affectionately refer to it as Season 1, Season 2, and Season 3. Season 1 was our set of ideas and predictions back from November 2019, which we had been developing and discussing in smaller audiences and in smaller groups over the course of 2018 and 19. In our 2019 report, Season 1, we made 8 core predictions, numerically defined predictions, which we'll be revisiting today to do very much a plan versus actual. We always believe in holding our own feet to the fire and be accountable for the predictions we make in the past and to test and measure how well they're doing now 2 years into the future. Earlier this year, we issued our 2021 report, which looked at how the pandemic was influencing Southeast Asia, but also a broader set of forward-looking observations around when companies ought to think about going public, what we called the cargo and the rails, the unique dynamics of emerging market tech ecosystems and the interplay between the historically extremely important telecommunications sector, which laid the table for the growth of the internet sector more recently. And finally, we began to highlight a few examples of industries in education and automobiles and travel and healthcare that were being influenced by and in some ways rising to the occasion to solve the problems that the pandemic had created. In this year's report, our beta version of our 2022 study, we'll be again holding ourselves accountable to those original predictions from 2019. We'll be updating our perspective on what's been a persistent Series C and D gap. And you might be surprised to know that while the gap remains on a region-wide Southeast Asia basis, it's actually reached parity with China, and specifically Indonesia. That has some interesting implications for how our region will develop. We'll also talk a little bit more about how we can contextualize Southeast Asia's technology sector development against a much broader framework of how China, Korea, North America, and other economies developed over the past several years. And finally, we'll conclude with a few parting thoughts as well as a prediction for how much market cap in tech Southeast Asia will likely generate by 2031. Let's jump in. What we'll start with is plan versus actual, actually our favorite section of the report, which is holding our own feet to the fire and examining how did those original projections from 2019 turn out. As you may recall from 2019, we had 8 core projections. The concept of Southeast Asia entering a golden age of rising affluence, which would in turn create very large technology companies. We'll revisit that. The concept of home court advantage across our region, which would confer a unique set of benefits, not regulatory or not legislative in nature, but authentically geographically local to our companies and create a degree of local insulation, as my co-founder Oliver so wonderfully says. We predicted 20 more billion-dollar tech companies from Southeast Asia by 2029. We got that sort of wrong, and then it's happened sooner than 2029. It's happened a lot sooner than we had expected. We said that at least half of those companies would pursue IPOs. That one's very much on track. In fact, there may be more than 10 that go public over the coming 10 years. We predicted that there would be at least an additional $400 billion of incremental equity value creation from existing companies and new platforms over the next 10 years, We're about halfway there, just 2 years into the 10-year forecast. We thought 70% of the winners would be regional and about 30% would be single country focused, specifically around Indonesia. That looks very much intact. If anything, there may be another way to build single country players, certainly in Vietnam and perhaps even over time in Thailand and the Philippines. We had identified about 28,000 alumni or graduates of the first generation of companies back in 2019, and about 1,200 of them had already gone on to become founders of companies, next generation companies in our region, much like the talent recycling that takes place in Silicon Valley and other ecosystems. Turns out we weren't looking hard enough. There are actually close to 9,000 next generation founders if we include a broader set of academy companies, most notably some of the more traditional technology businesses, which were the only game in town back before 2009, when C was founded, and 2012, when Grab was founded. And finally, a prediction that we've gotten right, but in some ways didn't want to get right. There remains an acute Series C and D gap in Southeast Asia, geographically targeted more on a regional basis than on an Indonesia basis. And we'll tell you a bit more about how those dynamics are playing out, both in Southeast Asia and vis-a-vis our neighbors to the north in China and to the west in India. With that, let's jump into each of the 8 and take you through a little bit of more granularity on what we got right and what we got wrong. We'll start with the golden age concept. As you can see from this chart, Southeast Asia is squarely in a band of affluence between roughly 3,500 US dollars to about 7,000 US dollars. Now, mind you, that's not per month, that's per year. These wages, these levels of affluence are in some cases an order of magnitude below what is typically common in many Western countries. But that is still very, very powerful. First of all, because it's greater than what we've been in the past, but as importantly, it is a unique band of affluence that has been correlated to the creation of what ultimately become very large companies. We'll tell you about this on the next page. When China was in its golden age band of affluence, let's call it roughly 2004 to 14, plus or minus a year, a number of companies in the technology industry went public. And those companies today account for roughly 53% of China's tech market cap. That is really interesting in our eyes. And that might just be a one-off individual country data point. It may not be indicative of something broader. But when you think about Korea today, well, the tech companies that went public in Korea's golden age, again, 1975 to 86 plus or minus a year, are 52% of today's current tech market cap. That starts to tell us that there's a pattern here. We even looked at Japan, and although Japan has left its golden age since 1960, it's almost 60 plus years past that point. Nonetheless, the echo of that golden age in Japan's case remains about a third of their tech market cap today, which is really remarkable, which is why we're really focused on figuring out what drives these dynamics. The more we look at it, it's the combination of several factors, the most important of which is ultimately disposable income, discretionary disposable income. It's in this period of time that affluence is, of course, rising. That's by definition. But to a certain extent, wants haven't yet become needs. What we actually find is that after you get past this blue zone, you tend to find that actually truly disposable discretionary income tends to peak and fall off after a little bit. This is the time when affluence is rising at such an interesting level in terms of percentage terms that it permits the creation of entirely new, very innovative technology companies. Now, technology today includes mobile and VR and a whole bunch of other interesting next generation areas. Technology in China's case, of course, was Web 1.0, the large horizontal web platforms that, of course, embraced mobile over time. Technology in Korea's case was more VCRs and consumer electronics. But the point remains, every part of Asia experiences its own golden age at some point in time. And it's the alumni, the children of the golden age, that go on to do great things. And we feel so fortunate that in our case, Southeast Asia will remain in the golden age for many years to come. In fact, it won't be probably until give or take 2030 or so that we'll have emerged from the golden age as a region. And by the way, just around that time is when India will be entering the golden age and create a tremendous amount of shareholder value and new companies at that moment in time. So that's prediction number one. So far, so good. That one seems to be relatively intact. Recent blips and bumps in terms of affluence of COVID notwithstanding, but the overall thesis is intact. The second prediction we made was around home court advantage. Any sports fan knows exactly what we're talking about. When your team is playing in its home stadium, there's just something magical about the way that they play. This manifests in business as well. And we've always thought of all the world's technology companies as living on one of three essential branches of a bonsai tree. Branch number one is what we know and love. These are the world's largest internet companies. They have network effects or two-sided marketplace platform dynamics, and those effects are global. And what is remarkable about being a global network effects business is that when you're in different parts of the world, you're the winner. The Google of Thailand is, no surprise, Google. The Facebook of Indonesia is Facebook. And that's mirrored by its doppelganger in some ways, which are what we sort of call the unique local winners. These tend by and large to take place in China and Russia because of the unique political systems over there and the legislative restrictions that certain global companies face. Baidu, in many ways, is a product of a very unique sort of circumstances. Yandex in Russia, vKontakte, which is in many ways the Facebook of Russia. Many people in the West think a lot about category two, and they think that that's sort of the only game in town when it comes to the internet. There's really the global network effects category ones, and there's a handful of these category twos. And I think one of the most canonical pillar, sort of observations, beliefs, core values that we have at Asia Partners is that there is a third way. And that's branch three, what we call local network effects businesses. And these are businesses that draw upon the same economic models that a category one draws upon. The idea of a network effect, the idea of two-sided marketplace, circular economies, virtuous cycles, if you will. But they tend to have a radius that confers strength within a region or on a multi-region basis, as opposed to a planetary basis. A great example would be the Taobao business within Alibaba. Alibaba, of course, was owned by a Japanese conglomerate and by an American conglomerate, SoftBank and Yahoo, yet succeeded magnificently in China. My co-founder Oliver saw this firsthand when he was at eBay and saw the rise of Alibaba's Taobao business in years past. Sea has built a terrific business in e-commerce and games in Southeast Asia, has now expanded its games business into India, its e-commerce business into Latin America, as well as games, and is going multi-local over time. It's a great example of a category three business, perhaps even one that's migrating into category one status. Grab, Gojek, Mercado Libre, Tokopedia, so many other good examples of this around the world. And when you think about what is it that drives a local network effects business, well, we'll talk a bit more about that today. And those factors that come together to permit a business to be a Cat 3 business versus a Cat 1 business tend to coalesce or conspire to create a new one of these models roughly every 12 to 18 months. In fact, here's a little bit of a walk down memory lane. What you can see in many, many cases is that the global inspiration for this model is often from America, increasingly from China or even Japan. Southeast Asia certainly doesn't have a monopoly on the origination of these ideas. But the local winner in that category, in that model, is often a local girl or a local boy. And that's a great source of pride for Southeast Asia, but there are some very clear reasons behind that, which we'll talk about in a moment. Our own investing effort at Asia Partners, as you can see from the blue highlighted cells, is very much aligned with this thesis. In fact, each of our first 6 investments and our fund zero, if you will, which is of course our early investment in C, and then my role and Brooks' role and Oliver's role as one of our shareholders at Sea, in many, many ways mirrors this theme of going after category 3 bonsai businesses. Now, why do category 3s exist? And frankly, this is a topic that in some ways perplexes the Silicon Valley and Seattle crowd because they're used to winning everywhere in the world. And when they don't win, they sort of wonder, well, was it something that they did? Was it a lack of capital? Was it a lack of focus? And while it's certainly the case that many factors dictate whether it's a local winner or a global winner, we would argue that there are some very structural factors at work, channeling our inner Jared Diamonds, so to speak, in terms of the role of geography and the role of different levels of affluence. Let's start with geography. One of the things that's just completely apparent when you look at Indonesia from the air, you look at America from the air, is how different the geographies are. Indonesia has at low tide about 17,000 islands. America is a proudly terrestrial nation with highways and railroads and flight networks and pipelines that crisscross the entire continent. From a land perspective, this has very important implications. You can take two regions which are demographically somewhat similar. Witness the fact that America has about 53 million people in its top 5 cities, so does Southeast Asia. America has about 80 million people in its top 10 cities, roughly the same for Southeast Asia. Of course, Southeast Asia has much larger heartland of rural communities that will eventually urbanize over time to some degree. But our point is two parts of the world that look remarkably similar, at least in terms of their top 5 and top 10 cities, could not be more different in terms of how their logistics work. Think of it this way, in a very simple sort of way. On a scale from 1 to 5, how important is what's called multimodal distribution, highway and rail, trucks and railroads? On a scale from 1 to 5, how important is the water-based logistics network? 5 the top, 1 the least, or 0 the least. America strikes us as a 5,2 kind of country, very, very reliant on road and rail, not terribly reliant, Huck Finn and Tom Sawyer notwithstanding, going down the Mississippi River. And what you see in Southeast Asia is literally the mirror inverse. Southeast Asia is a 2,5 kind of market. And you see that in all sorts of ways. For example, if you look at container ports, 8 of the world's 35 largest container ports by volume, by TEUs, are in Southeast Asia. Only 3 of them are in the US, which, by the way, may have something to do with the fact that the supply chain is kind of gnarled up right now in the US. But 8 of them are in Southeast Asia. On the flip side of that, the US has 14 times as much highway as Southeast Asia does, and about 5 times as much railroad as Southeast Asia does. That tells you a lot about how logistics will be handled differently in these parts of the world. And it requires not just a different mindset, but different IT systems, different partner and ecosystem vendor networks, different approaches to warehousing and logistics, and even different approaches to how you engage with the customer on the ground. For example, let's talk about how you build a logistics network from a topological perspective, from a graph theory perspective. Not every package in America goes by FedEx, and not every FedEx package goes through Memphis. But when you think about how that hub and spoke system has been designed, it's been designed for the efficient transit of very high value packages. A legal contract that must be inked pre-DocuSign on FedEx, that's a high value package. It's all right to send it from city A to Memphis to city B, even if city A to city B were just a 4-hour drive apart, because of the value of the package. But when you're thinking about lower value packages, a $4 fast moving consumer goods FMCG package, a $1 e-commerce package, these are very uneconomical to transport using the traditional American styles of doing things, but they work very well through what we would call a propagation network. And propagation networks aren't rocket science. In fact, they're the opposite of rocket science. They're how we used to ship things and deliver things for thousands of years. You start at a major hub in the center, let's call that Jakarta. Then you ship it to a distributor, maybe in Surabaya, who ships it to a wholesaler in the Surabaya suburbs, who ships it to a dealer in an even further suburb, and that dealer maintains a network of about 100 or 200 little stores that they sort of work with on a day-to-day basis. That's how logistics happens in the offline world, and increasingly it's happening on the online world. Not just because consumers are picking up e-commerce apps, but in the case of one of our portfolio companies, Gurangada, which serves 500,000 small and medium-sized businesses across Indonesia, it's become the e-commerce platform for the 90-odd% of retail that still is offline, and very efficiently so offline for very small value packages. This is a really interesting concept. The idea of very small price point offline e-commerce being enabled by digital e-commerce on the back end. And the results have been magnificent in Gurangada's case. Such a really interesting growth in revenues, in users. We estimate, for example, that the 500,000 users they have of the Gurangada mobile app are roughly responsible for employing about 3 million people across Indonesia, who in turn serve perhaps 100 million plus of consumers across the entire set of archipelagos. And again, the Gurangada app works beautifully because of the propagation network. Head office of manufacturer sells to distributor, sells to wholesaler, eventually to the consumer. And at every stage along that value chain, you can use the Gurangada app to progress the goods to the next point along their graph. Another great example of why Cat 3 businesses structurally exist has to do with pricing. Now, pricing is one of those topics that is just such an important aspect of business. It's not that you want to overprice or underprice, you want to optimally price. And the fast-moving consumer goods industry, back to that analogy again, has been absolutely superb at figuring out what is the right price point and corresponding volume of product to sell a consumer. And here, there's a really great concept that comes out of operations research, which is turning out to have some salience to the digital realm, which is called the economic order quantity, the EOQ. It's a very famous quantity back when people were studying the case studies of Toyota and Kanban. And the whole concept of EOQ is order enough so that you can balance out the conflicting demands of never running out if there's a cost to running out, but not ordering so much that your inventory cost in terms of the space and insurance and labor for your warehouse, and at the same time, the capital cost of that inventory, including the cost of capital of just buying work in process inventory or even just unfinished goods on the back end, becomes too much. There's a balance point. And if the variability of your supply is very low because the factory of your supplier is next door to you, and if the carrying cost is very low because interest rates are low, then that changes your thinking in either way. Think about it from the consumer's perspective. The consumer in emerging markets, often back to the golden age chart, has an affluence of less than $7,000 per year. In many cases, like in India, less than $3,500 per year. For them, working capital is very precious. They don't have a lot of liquid net worth to draw upon. They're not interested in buying the 30-gallon Sam's Club or Costco mega pack or the cubic yard of cornflakes. They're going to buy what the FMCG industry calls a sachet. And a sachet is a small little package like a sachet of tea. But it could be for shampoo, it could be for soap, it could be for anything you need around the house. And you see that these images over here where sachets have very much become the modus operandi for the FMCG industry. Now, it must be said that it comes at an environmental cost in terms of a lot more packaging material per unit of goods, but it's also affordable and permits livability for these families. One of the really interesting analogies or extensions of this idea of the EOQ and the sachet is to digital. Terrific businesses like Netflix have been slowly expanding beyond their core markets of the affluent West into the world's emerging markets. And when you think about their success or their challenges, let's contextualize it for a second. This is a very straightforward comparison of how Netflix prices its standard monthly subscription across a host of different countries. And you might say, gosh, that makes sense. India's at 8.9 a month, and India is a little bit less wealthy than the Philippines, which is at 9.5 a month. And the Philippines is a little bit less wealthy than Indonesians at 10.9. And that, of course, goes to Malaysia at 11. That goes to France at 15 and Germany at about 16. This makes perfect sense. And yes, it's true. It does make sense that if you're a more affluent country, you should price a little bit more. And if you're a less affluent country, you should price a little bit less. But that may not be the full picture. If we divide this column of numbers by monthly GDP per capita, annual GDP capita divided by 12, divide the first column into the second column, and what you suddenly see is eye-opening. A Netflix subscription in India costs 4.85% of monthly GDP. And not all GDP goes to consumers. Some of that goes into taxes. A lot of that goes into the basic essentials of life. By the time you're left with just the actual discretionary disposable income, boy, that's a very high ratio. It might even be approaching 100% for many, many consumers in India. On the flip side of things, look at Norway. In Norway, a Netflix subscription is a barnacle on the bottom of the hull of a very large boat. You don't even notice it's there. I would posit that most Norwegians cannot tell you to the nearest basis point how much their Netflix subscription costs as a percentage of their monthly wages. It's just too small a number. And this reveals something very powerful. A subscription of a certain amount of money per month, as opposed to a sachet, may make more sense in affluent countries than it makes sense in less affluent countries. And you might say to yourself, or say, hold on a second. This is the Netflix standard subscription. I mean, don't they have like an emerging markets plan, a basic plan? So we did look at that. This is the Netflix basic subscription price. And you're right, it's a little bit less, but for heaven's sake, it's still 3.73% of India's GDP per capita on a monthly basis. Wow. All right, so it starts to really validate this thesis. Where is that transition point? We've obviously had a discontinuity in the table here, a whole bunch of lower income countries and a whole bunch of higher income countries. Is there sort of like a sweet spot or a tipping point? Well, there's a clue in the history books. In 1999, a terrific games business in Asia called Nexon launched its first item-based, sachet-priced game. And this may not seem like it's terribly innovative by the world of 2021. Back in 1999, this was a big deal. In 1999, you'd go to Toys R Us or Walmart or Takashimaya or whatever, and you'd buy a boxed game for your child. It would come in a little cardboard box. It would have shrink wrap plastic around it. There'd be a CD-ROM or a cartridge, and you'd pay $39.99, $49.99, something like that, and that game would be yours to license forever. There was no concept of we'll give you the game and we'll sort of charge you on the come, but that's exactly what Quiz did. And what's really interesting is actually Quiz wasn't the first free-to-play item-based game in the world. That distinction goes to an American game called Achaea. And we think of Achaea as sort of like the equivalent of Deming and the quality revolution. Deming was a terrific professor at NYU, if memory serves. His ideas took root most quickly and most productively in Japan, and were in some ways the underpinnings of the Toyota quality system. Whereas in many ways, they were neglected in the West until eventually Japanese competitors made it an imperative for American firms to catch up on what one of their own had already created. In the same way, Achaea was actually the world's very, very first free-to-play item-based game, but the actual model languished in America. But it worked for Quiz, and then the successor game to Quiz, not in genre, but the developer, Lee Sung-chang, was the same person, was MapleStory. And MapleStory was a very big deal. Most people in the West haven't even heard of it, but MapleStory was about as important in Asia back then as Star Wars was in the West. It was a really, really popular game, and it's gone through all sorts of version upgrades as time has passed, but it worked in Korea, it worked in China, it worked in Southeast Asia, and it was an item-based game. And notice something interesting here. The countries which an item-based game seemed to work really well in seem to be kind of just below this blue zone of affluence. That's kind of interesting. And when you think about on this next page, countries where subscription models work really, really well, that's above the blue zone. There's something very powerful going on over here. And it's not to suggest that actually being item-based is just a lower end strategy. We are blown away by the fact that when we look at the market cap of predominantly item-based companies in games, C, for example, at $160 billion market cap today, Tencent at about a $500 to $600 billion market cap today, they're actually rather larger than their American peers who began, again, as boxed games, eventually became subscription-based and have some degree of free-to-play today. But a bit like the innovator's dilemma, once you start with a license-free upfront or subscription, it's mighty hard to change that policy. That's a bit of what I think Netflix is going through right now, where again, even though their India price is lower than their Norway price, it's still approaching 4 or 5% of GDP per capita on an annualized basis, which is a really tough sell. Whereas an item-based sell works really, really well. Let me just throw one other idea at the group, which is when you think about this notion of Cat3 businesses and local authenticity, one of the really interesting things that we're stumbling across is that as you go from that golden age of affluence, which is from 3,500 to 7,000, and then what we would sort of tongue-in-cheek call the platinum age of affluence, which is 7,000 to 14,000, the interplay between different parts of Asia that are in the golden age versus in the platinum age is really interesting. In fact, countries that enter the platinum age, again, not very affluent by Western standards, but very meaningful in the journey of Asia, they're considered success stories. They're considered actually very aspirational in terms of their fashionability, their forward-lookingness, their view of how the world is going. People look up to them. And when you think about a great example that is a fashion example, it's of course the cosmetics industry. Shiseido in Japan in the 1950s and 60s, K-beauty more recently today, J-beauty and then K-beauty were very much the trendsetters in Asia over the last 40, 50 years. And when you think about the interplay between golden age countries and then platinum age countries, and really golden age and below, to make it more of a broader observation, something really interesting pops out of the data. Shiseido was born in Japan, was the leading cosmetics companies of its era in Japan, and it began expanding out of Japan in roughly 1958, when Japan was just emerging out of the golden age. It hadn't even quite crossed out of the blue zone yet, but was just a few years away from that. It was just really interesting in terms of how their economy was growing, in terms of how their sophistication of technology and their affluence was growing. And much of Asia looked up to Japan after 1950, 1960, and even before, from an economic perspective. And that led them to open up Taiwan, Singapore, Hong Kong, then Hawaii, then America, then Europe, and then ANZ. And you know what? The very first wave of Korean beauty was at roughly the same point, not the same year, a generation later, but the same point in terms of where Korea was in affluence, just about up to exit the blue zone, not quite over the hump yet, but just about to exit the blue zone. We think this is fascinating because what it tells you is that as countries in Asia migrate from one tier of affluence to the next, you can start to make predictions that in fact they will start exporting culture, yes, but product as well. And we would argue that the next few years will see a great rise in sea beauty because China has already exited the blue zone. In fact, there are already sea beauty brands that are doing very, very well, selling into Southeast Asia and beyond. Many of them not yet global names, but like Shiseido, mark our words, over time they will be global brands because they're finding their footing right now in the Southeast Asian context. And that isn't true just of cosmetics and product. It's also true of what you could broadly call IP-based products, music, film, games, and so on. Japanese games were all the rage many years ago. Remember Nintendo? Korean games are all the rage right now. Look at players like Electronic Arts Studio in Korea, which developed FIFA, and many, many others. The same thing happened in music. In the case of music, J-pop dates back to, roughly the 1990s. And it's not a too far stretch, plus or minus a few years, to see parallels to K-pop today. Likewise, J-film and also K-film. Anybody that's watched Squid Game recently on Netflix knows exactly what we're talking about. And we would predict as well that C-pop and C-film will become a very big deal over the coming years, and eventually ASEAN pop and ASEAN film. But that may take a lot longer. Again, it's deterministic based on where you are on the curve of affluence. Our next prediction was around the fact that there would be at least 20 more billion-dollar tech companies from Southeast Asia by 2029. Boy, back in 2018, when we first started sharing this with folks, and then 2019, when we published it, people thought we were nuts. I mean, it was arguably considered to be a controversial projection at the time. C had just gone public. There were a few privately valued companies sort of in that billion-dollar mark, but people almost thought, all right, that's going to be it. I mean, that's kind of the lid on the whole pot here. And look what a difference 2 years has made. We are very, very transparent in wanting to tell you we got this one wrong. We were too low in terms of the number. Let's look at the data. We had a view back in 2018, which we then formalized in 2019, that when a part of the world gets to about 10 or so billion-dollar companies, we hate the word unicorn, we'll just call them billion-dollar companies, there's a bit of an inflection point. Things start to move pretty quickly from that point forward. That was 2013 in America. That was 2014 in the case of China. And it was roughly 2017, 2018 in the case of Southeast Asia. So in 2018-19, we said there's going to be at least 20 more. We'll go from about 15 to 35 by 2029. Boy, what a difference a couple of years makes. America has gone up to 400 plus. China has gone up to 160 plus. And Southeast Asia is now, by some estimates, and definitions vary, perhaps 39 of these. Now, we can make two observations here. Number one, I think, our heart was in the right place, but boy, did we get the timing off. This was certainly faster than we thought. And part of why that is if you were to look at these same set of numbers over here on a log y-axis, a logarithmic y-axis, same x-axis, same timeline, you start to see a more coherent pattern. There's sort of a progression that you see, almost a bit of a straight line in America, a little bit less so in China, perhaps for internal reasons around the regulatory environment in China. And again, a relatively straight line here for Southeast Asia. Perhaps we ourselves fell into that trap that actually in the near term, many people forget that over time, the world does move exponentially, even though our predictions for long periods of time are more linear. That's probably a little bit of what happened here. I would also argue, not to sort of justify the fact that we were off in terms of timing, that there's a little bit of a bubble going on right now. So we stand by our prediction of 20 at least by 2029, but we are also pretty confident in saying that 20 will prove to be conservative. It will be more than that, in as much as some of the current 39 so-called billion-dollar companies may be a little bit overvalued in the present day. But the point is this, it's really quite exciting to see what's happening. The potential of Southeast Asia is starting to manifest and materialize in billion-dollar and in some cases multi-billion-dollar tech companies. We then predicted that about half of those companies that would be created would eventually go public. So out of the 20 more, there'd be at least 10 more significant IPOs between 2019 and 2029. That's very much in process. And the reason that we felt confident in that belief is that if you look back at China as the most recent part of Asia that's gone through that golden age, again, it was roughly 2004 to 2014, give or take, since out of it, but fairly recent in our memories, China went through a very systematic process of building tech companies and taking them public. If you think about how it happened in 4 or 5 key stages. There was an initial stage of telecommunications IPOs, what we call the railroads. Then you found the first generation of cargo on the railroads, typically around the world, ads, games, and travel IPOs online. Some people would call this Web 1.0. Then you started to see the unbundling of the historical newspaper classifieds business, online classifieds for jobs, online classifieds for flea markets and sort of goods, used goods, new goods, online used cars, online real estate. And in parallel with that, early classifieds markets for used goods give way to true marketplace e-commerce, both inventory-based and marketplace-based for new goods, which in turn then leads to a new generation of companies that provide services to the recent newcomers to the party. Online payments, e-commerce logistics, online security, online lending for working capital. And finally, what often happens near the end of this progression is the most conservative industries go online. The taxi and transportation industries, the restaurant business, the healthcare industry, and so on and so forth. These sorts of things take their own time to grow. And this is a wonderful progression that's taken place in China and created trillions of dollars of shareholder value. And we emphasize this history because on many dimensions, Southeast Asia is actually about 10 years behind. Not deterministically 10 years behind, although we are about 10 years behind China in terms of GDP per capita on a regional basis, but informally about 10 years behind. Our IPO at Sea was exactly 10 years behind the first China e-commerce IPO. That was the Alibaba.com e-commerce business that went public in Hong Kong. Now, sometimes you'll find leapfrogging. For example, Grab's de-SPAC is widely expected to take place in December or January, probably December. And that's probably just a few months after the a bit bumpy Didi IPO that took place from China. But in broad brush terms, this concept of having a bit of a predictive lens to say, companies will go public in a similar sort of sequence, particularly if they're Bonsai category 3 companies, is very much intact. And it allows us to make the prediction that there will be at least 10 more IPOs out of those $20 billion companies, and perhaps many, many more than even that, as we're starting to see. Already, there have been 2 very significant IPOs that completed in 2021. Bukalapak raised $1.5 billion on the Indonesian stock exchange. It was the largest ever IPO in Indonesia. And while the price has been a bit choppy, it cannot be disputed that the company raised $1.5 billion in capital, which is very useful for its business in terms of its growth, and ultimately provides a path to liquidity for its early backers. TDCX was a company that many hadn't heard of, and they went on to raise a significant amount of capital and are now a roughly $3-ish billion public company out of Singapore, but traded on the New York Stock Exchange. Again, a great example of a wonderful, kind of almost in some ways under the radar company that built real scale in Southeast Asia and went to the US public markets. Grab, Finexcel, Traveloka, GoTo, we would say that at least 2 or 3 out of these 4 will likely end up public in the relatively near term, next couple of years. Grab seems, quite likely to be the NASDAQ in the next few weeks. From where we film this today in December 2021. And the others are either in talks or in early preliminary discussions to give this some serious consideration. over the coming months, which leads us to how we think about our investing program in Southeast Asia, which is very much filling in the rest of the gaps. In fact, when you think about where the opportunity lies over the next several years, in many ways, it's simultaneously to take the second company and the third company public in a row, shaded here in gray, which has already generated at least one public company in Southeast Asia's internet landscape, or to occupy the white space. And for our Fund 1 at Asia Partners, we've been very focused on the white space. So our 6 existing portfolio companies, hopefully, touch wood, more to come, are very much geared around areas where there had not been at the time of our investment, and in some cases still is not, a publicly traded company in that category of business models, which have already been well proven out in China, and which generally tend to be in the areas that we're looking at, category 3 bonsai businesses. One of the things that's actually very interesting to sort of maybe share with all of you is that while Southeast Asia has a little bit of a perception of being a land of infrequent IPOs, we want to maybe just share some raw data that might change your view on that topic. You're very correct in believing that there aren't that many historically US IPOs out of Southeast Asia. There was our IPO at Sea. Now, more recently, there, of course, is the de-SPAC of Grab, and the other one that just happened a few months ago. But a lot of the action is happening, quote unquote, below water level, at the local level in Southeast Asia. And we'd all agree that the US exchanges, and perhaps the British exchanges and the Hong Kong exchanges, are probably the most liquid in the world. But in terms of raising nourishing capital for companies, and over time in an orderly way, perhaps a slightly longer period of time in these smaller exchanges seeking liquidity for investors, local exchanges have an important role to play. So to maybe ground ourselves in what the reality was, what we did is we went on Bloomberg, we pulled down every single IPO on the planet that had raised at least $100 million as a cutoff since January 2015. And we looked at where the headquarters were of those companies. We're not looking at where they went public, we're looking at where they came from. And then we can assess where they went public. The biggest region in the world in terms of companies going public is, of course, the United States. It's the absolute giant gorilla in terms of the volume of capital raised by American companies. And most of these companies go public in America. But again, that's not what we're looking for here. We're looking at where they're from. Number 2, not surprisingly, is China. China's curve actually crosses the US curve in that in China, there's actually a slightly larger set of companies at the top end. Think about the Alibaba monster-sized IPO some years back. But then China doesn't have quite as much depth once you cross past about company 125 by size over these last 5 or 6 years. So in sum total, America is actually larger, in as much as there's some very large IPOs that have come out of China. Number 3, not surprisingly, is Western Europe. Again, a very large bench of companies in a very large economic part of the world. And then there's a gap. Number 4 on this list is Latin America. And Latin America has some distance. And this is, again, a logarithmic chart on both axes. So you can see the power law distribution dynamics. And number 5 is Southeast Asia. Every other part of the world falls beyond Latin America and Southeast Asia. We want to share the data with you in raw form so you can actually see it. And we also want to make a prediction. In the next 5 to 10 years, Southeast Asia and Latin America will flip position. Southeast Asia will become the world's 4th largest region for IPOs, domestic, local, and international. And Latin America will still be very important, but probably be number 5. There will still be a great gap between Southeast Asia and Western Europe. But in, I think, the consciousness of investors globally, there will be the big 3, America, China, Western Europe, and then Southeast Asia will come forth, which we think is a very important development and has real implications for how portfolio allocations should be thought about on a going forward basis. The last thing we wanted to share is when you think about contextualizing Southeast Asia's IPO productivity, again, a good chunk of it happening locally as opposed to on the US exchanges, but changing with Sea's US IPO in 17, Grab's de-SPAC in 2021, and so on and so forth. If you contextualize how big is Southeast Asia's IPO productivity, one way to think about it would be to say, what's the total amount of capital raised by different industries around the world? Every country, every exchange, but just industries, IPOs. And of course, no one would be surprised to see that the largest industry for capital raising in IPOs has been internet, since the beginning of 2015. The second largest, again, no surprise, software. The third largest, no surprise, biotechnology. These are sort of the big three in terms of venture investment, in terms of IPOs, followed by business services, followed by retail. And then if you were to just artificially insert Southeast Asia as a region, Southeast Asia would be the world's sixth largest industry. Now, of course, it's not. It's a region. In fact, all of this Southeast Asia blue bar should be allocated to the gray bars on the chart, but it just gives you a little bit of a flavor for the significance of Southeast Asia's IPOs on a local basis, which will over time, we believe, migrate in some meaningful way onto the international US exchanges and abroad. One interesting footnote to this in terms of local versus international exchange is the story of Indonesia. If you think about Indonesia in the 1990s, about a quarter of the capital that Indonesian companies raised in IPOs came from America. In fact, Telecom Indonesia, PT, Telecom Indonesia, is still a publicly traded ADR in the United States. That's a product of that 1990s era of IPOs. And it was actually a bit less of a ratio for Chinese companies in terms of total capital raised by Chinese companies in the 90s, America versus their Hong Kong and domestic exchanges in China. Interestingly, if you flip forward to the last 5, 6, 7 years, Indonesia hasn't raised a single dollar on the US exchanges. In fact, it's been primarily an Indonesia domestic story for listings. And in fact, China has also shifted a bit more towards raising capital on its own exchanges in Hong Kong and on the mainland. But it still has, from time to time, tapped into the US. Again, witnessed the Alibaba IPO some years ago. And if we limit this analysis to just tech, one of the really interesting things is that in Indonesia's case, more than half of the tech capital that was raised, primarily telecoms back then, was in America, and now it's been zero for the past 7 years. Witness Bukalapak going public domestically. There's a couple of reasons for that. One of which is just the shrapnel and the scar tissue from the Asian financial crisis in '97, which in some ways set the connection between Indonesia and America capital markets back a little bit. Part of it is tax. An Indonesian company that goes public on the local exchange in Indonesia lowers its capital gains tax for Indonesian selling shareholders to 0.1%. That's a very tempting reason not to go public abroad. But we would put this on the record now to say that over the next several years, the left-hand side of the page will start to reemerge. It may not be 55-45 going forward because that tax incentive is a very strong one. But for non-Indonesian selling shareholders, venture investors, conglomerates, family offices around the world, it's a very logical thing to want to sell on the US exchanges. And from a pure liquidity and then ability to raise converts in the IPO market beyond the original listing, the capital markets beyond the listing, there's a lot of very good reasons when we public abroad. So we would just say, watch this space. Watch this space. The mix will tilt back towards the US, particularly now that a new generation of technology companies has arisen in Southeast Asia and in Indonesia specifically. And with that, for prediction 5, I'll hand it over to my co-founder, Brooks Apanasanti, who was a key part of C's 2017 IPO.
Thanks, Nick. In our 2019 Internet report, we made a very specific prediction. New and existing tech companies in Southeast Asia would generate an incremental $425 billion of shareholder value creation by 2029. This is a topic that is very close to our hearts. 3 of our co-founders, including myself, were part of the C journey, and being part of C's 2017 IPO was one of the most exciting moments of my career. I'll never forget the moment we rang the opening bell on the New York Stock Exchange, and then when we rang bell on the trading floor, when trading in our stock began later that day. In the years since our IPO, C has put that capital to good use. C's share price has grown from $15 a share at the time of the IPO to $290 today, a 19 times multiple. When we look back at the last few years, C has been the top performing mega cap stock on the planet with 120% IRR since January 2018, alongside companies like Tesla, Shopify, and Square, and a sign, we think, of things to come with a Southeast Asian company at the top of the list. At $160 billion of market cap, C is today the largest company in Southeast Asia across any industry. and the lift in shareholder value since our prediction in December 2019 has been about 140 billion US dollars. Going back to our prediction from a few years ago, we looked at the ratio of technology market cap to GDP in Southeast Asia, which was just 2.2%, and compared that to China's ratio of 16.6%, which suggested to us that if Southeast Asia was to catch up to China over a decade, not in GDP or even GDP per capita, but in the ratio of tech market cap to GDP, then there would be an incremental 426 billion US dollars of new equity value by 2029. Based on current valuations, we are almost halfway there after just 2 years. It's worth pointing out that markets give and markets take. And as we'll share at the end of this year's report, we think that the global equity market are definitely overvalued. But all that said, it's an encouraging sign that this early in the journey to 2029, we're almost halfway there. In fact, we've updated our views on where the incremental market cap is likely to end up, which my co-founder Petra will share later in this report. In a nutshell, we think that the tech sector in Southeast Asia, including telcos, will end up around 1.2 trillion of market cap by 2031, 10 years from today. How we get there is almost certainly not going to be a straight line. It will have plenty of cyclical ups and downs along the way, but the long-term trajectory is very interesting. And with that, I'll hand it over to my co-founder Oliver to talk about our next prediction from 2019, how companies will navigate the choice of whether to be single country or multi-country platforms.
Thanks, Brooke. Let's look at the next prediction that we made. We made a prediction early on, and this was informed by our lived experience at companies like Sea or Bukalapak, that about 70% of the winners will be regional platforms and about 30% will be Indonesia-focused platforms. So let's have a look whether there are proof points out there that support that prediction. First, let's ground ourselves in the chessboard of Southeast Asia. So these are all the relevant markets in the region and key variables that determine whether companies can be successful and can scale up into large businesses in those markets. And a few things stand out. On one hand, you have very large countries like Indonesia, about 2.7x population-wise compared to the number 2 largest country. And on the other hand, you have countries like Singapore, Malaysia, that always have been great at scaling across the region, using those countries as a launchpad for pan-regional strategies. And this has led to our prediction of 2 strategies that we are observing in the market. Strategy number 1 is a strategy to go big and deep into Indonesia, to really tap into that large market potential there. And strategy number 2 is one where you use Singapore or Malaysia as a launchpad, and you launch then pretty wide into the rest of the region. What is interesting to observe, in the past year or 2, we have seen the emergence of a potential strategy number 3 as well, where due to the rising affluence, also countries like Vietnam could be big enough now to support country-specific strategies. So if you look at the first generation of large tech companies in the region, that roughly supported that 70-30 split in terms of regional businesses and Indonesia-specific businesses. So you have a handful of Indonesia businesses, that's strategy number 1. You have a majority of pan-regional businesses, that's strategy number 2. And you also have early indicators of that strategy number 3, country-specific, other country-specific businesses in the case of Vietnam here. So if you now look at the indicators, leading indicators in terms of whether we will see that roughly that split be replicated into the future, it's good to look at the upstream ecosystem and where are companies that are getting funding headquartered, in the region. And again, it supports that split that we had predicted. You have about 23% of companies being Indonesia headquartered, then a majority of 60% being headquartered in Singapore, Malaysia, and a handful of other country-specific places headquartered elsewhere. So how do you actually execute that strategy 2, that pan-regional strategy, which is where the majority of those companies will come from? So let's go back to the chessboard. you headquarter your business in Singapore or alternatively Malaysia, and that's where the majority of your C-suite sits. This is also where your chief growth officer sits, who is planning the regional rollout strategy. Singapore is also the place where you have your first centralized tech team with maybe some outsourced support elsewhere. And from there, you pretty swiftly launch in-country organizations in all the relevant markets in the region, and over time implement strong local leadership there. So does the data support such a Singapore-led regional expansion strategy? So let's look at LinkedIn. So if you do a LinkedIn search and you look at all the roles globally that either have Asia Pacific, Asia, or APAC in its title, it's actually quite remarkable that 25% of those roles globally are headquartered in Singapore. So that would support the thesis of regional businesses, maybe even Asia-wide businesses being headquartered in Singapore for B2C businesses, for enterprise software businesses, maybe in the future even for semiconductor-related businesses or other hardware-related businesses. So let's look again at LinkedIn. If you look now at the raw programming talent or the data talent, Singapore's, again, punching way above its weight class and has a disproportionate high share of such talent. And if you actually look at a more senior leadership within tech organization, that doesn't only include CTO, but also other roles like Chief Product Officer, for example. Again, Singapore stands out as a good place to place that talent in. What is encouraging, though, is if you look at the raw programming talent in the region, and this is a prediction that we made about a year ago, where it seemed to indicate that the rest of the region is catching up to Singapore, that actually seems to have happened by now. So Indonesia is now slightly ahead of Singapore in terms of absolute numbers of programmers, and that slightly is expected to be larger in future as well. In terms of data talent, all the countries in the region have grown quite nicely as well, but there's still quite a distance between Singapore and the rest of the region. So it's probably going to take a few years for the rest of the region to catch up with Singapore here. And with that, I hand it over to my co-founder, Kian, who is also a former education industry entrepreneur, to talk about the talent environment in Southeast Asia.
Thank you very much, Oliver. One of the most important aspects of value creation is talent. Beside each successful entrepreneur's special circumstances, experiences, and education plays a pivotal role in shaping the entrepreneur's journey. When we published our first report in 2019, we were cautiously optimistic that a new generation of entrepreneurs who had real on-the-job training in our region's first generation of tech platforms were recirculating across Southeast Asia, similar to how a generation of HP and IBM alumni fueled the early days of software in the United States. With the benefit of hindsight, there are even more alumni than we realized. We thought back in 2019 that there were at least 1,200 alums who were now founders or CEOs. If we take a broader lens and include some of the early tech employers in our region, especially the telco, the number is closer to 9,000. It's not surprising to us to see so many alumni of more established tech companies becoming entrepreneurs. C was only founded in 2009 and Grab in 2012. Before then, if you wanted to work in tech in Southeast Asia, you'd be working at IBM, Oracle, Microsoft, or a large telco like Telkom in Indonesia or Singtel in Singapore, or in software outsourcing or integrations with the likes of FPT in Vietnam. We think this chart will look fairly different in a few years' time, as even more alumni emerge from C, Grab, Gojek, Tokopedia, and others. And it will be one of the most important leading indicators of value creation in our region. After all, there is no better way to learn entrepreneurship than the school of hard knocks, and that is what this page represents. The School of Hard Knocks had a double benefit. It opens up entrepreneurial careers to a broader set of talents and makes it easier to build a regional company. Why do we feel that way? Well, if you look at the first generation of big platform founders in our region, every single one of them who were strategy 2 companies, which grew regionally, had rather unique and fairly rare backgrounds. They had all been educated in the US, either for undergraduate or graduate school, which is often where they met their co-founders, potential business partners, and early employees who helped them scale regionally. Many of them were alumni of the largest global consulting firms. While that special set of career experiences certainly helped them on their journey, not that many people have the good fortune to have precisely that resume. And in fact, the 2 large platforms that had founders without that kind of US education, Tokopedia and Bukalapak, ended up going down a strategy 1 path, meaning an Indonesia-only strategy. That we're seeing now is a new generation of founders, back to the previous chart, that have been deeply embedded in the companies above, along with a few others, and they've learned how to build regional platforms, in many cases on the job, rather than having to figure it out for themselves like the pioneers did. But that doesn't mean that going abroad to study is not helpful. It certainly is, especially to build technical skills and to meet future co-founders, business partners, and employees. And on that count, we really wanted to highlight my home country of Vietnam in a trajectory that is very similar to China a generation ago. Vietnam has grown the number of undergraduates it sends to the US for college by 12 times over the past 20 years. Those students come home with great education and also from their on-campus friendships, a regional network that will help them a lot to build regional businesses. That's not just true at the undergraduate level, but also at the graduate school level. Vietnam has grown the number of graduate students it sends to the US by 7.5 times in the past 20 years. That's remarkable, especially contrasted with Japan, which has declined. We would say, watch this space. This cluster of talent is going to do great things over time, not right away, as they're still young, but as they say, demographics is destiny. When these many smart students come back home, and some has already done so, with strong technical skills and a broader set of perspectives and networks, interesting things tend to happen. And with that, I'll hand it back to my co-founder, Nick, for the last of our predictions from 2019.
Thank you, Ken. Let's shift to our 8th and final prediction from 2019, the existence of a Series C and D gap in Southeast Asia. The reality is that there still is one, and there's many reasons for why that is, but it continues to be a source of pain for entrepreneurs in our region as they continue down the journey of building their company. Just so that we can align on terminology, because a Series A and a Series B and a Series C can mean such different things in different parts of the world. Let's just arbitrarily call a seed round to be roughly 0 to 1 million. And let's call a Series A and B in Southeast Asia roughly 1 to 20, Series C and D roughly 20 to 100, E and F 100 plus, and then usually by then companies are beginning to think about an IPO, and many companies, including C, have gone on to raise capital in the credit markets, in the convert markets or otherwise, post-IPO. For today's discussion, we're going to be very precise and look at rounds between $20 and $100 million and compare that to what's happening in the 1 to 20 zone and in the 100 plus zone. And again, we'll loosely refer to this as Series C and D, but what's more important to us is actually the numerical size of the round so that we can be very precise and comparative across different parts of the world. Now, back in 2019, we calculated that there was a roughly $930 million annual gap in that $20 to $100 million zone. And we got there by comparing and contrasting the amount of capital deployed in China from 2014 to 19, sort of a 5-year longitudinal period, which was about 5.7 basis points of GDP, to what was happening in Southeast Asia, which was closer to 2.7 basis points of GDP. And if we simply incrementally lifted that to where China's level was, and we multiplied it by Southeast Asia's GDP in 2019, it suggests that there was approximately a $930 million gap every year. There was a $3.7 billion gap relative to America, but we weren't even thinking about that. Just in terms of catching up to the most adjacent geography in terms of time, in terms of which part of Asia had most recently been in the golden age of affluence, the $930 million quantitatively and also anecdotally rang true. We have updated these numbers to now look at this from not the 2014 to 19 time period, but the 2016 to 21 time period, rolling it forward 2 years, if you will. And on that basis, the gap has gently increased, actually, rather than decreased. It's now 1.1 billion. Some of that is the Indonesia portion of it. Some of that is the Southeast Asia, ex-Indonesia portion of it. But in aggregate, again, there's about a $1.1 billion gap to China. And that gap to China exists not because Southeast Asia's capital markets haven't grown in terms of supply. That's happened. But China itself has also grown in supply as it's become a more sophisticated economy. So the gap to China persists, and that creates a tremendously interesting opportunity for investors in the Series C and D segment. At the same time, it creates a tremendous amount of hardship and frustration for entrepreneurs that are trying to raise that next round to eventually get them closer to an IPO. And what we want to do in today's conversation and in our 2022 study is to try to be a little bit more precise about what's really happening between input capital and output capital, upstream and downstream. When you put capital into an ecosystem, how does it eventually translate into long-term value creation over many, many years in the public markets? So what we'll start with are the core inputs that go into this, and we'll be revisiting some of these concepts around the Series C and Series D gap, but it's worth just reiterating for completion's sake that the inputs are really three things. It's the actual macro potential of the economy, what we call the golden age. It's the human capital of the economy that my colleagues have shared so much interesting data on. And finally, it's the financial capital that we'll dwell on a little bit more in this section, all three of which ultimately turn into the output, which is public market value creation on the back end. Let's zoom into the financial capital, specifically the $20 to $100 million gap, which is a very important topic here in Southeast Asia. If we go back to China, it's very, very helpful to contextualize where we are relative to our most adjacent neighbor, both geographically, but also again in terms of which country has most recently been in the same strata of affluence that Southeast Asia is in today. China was in the golden age from 24 to 2014. What you notice in China over the last roughly 5-6 years is that $20 to $100 million capital, what we would call growth equity for tech, oscillates sinusoidally between roughly kind of give or take 7 and 12 basis points, but it averages to about 9.66 basis points of GDP. So in any given year, China's investing about 9.66 basis points of GDP into these privately held technology companies. Some of that money is domestic, a lot of that money is from abroad, but this is the capital going into these high growth startups in China. If you think about Southeast Asia has been historically investing about 5.6 basis points of GDP over the last several years. And while China's gently drifted upwards, South Asia's gently drifted upwards as well, but there remains a roughly 4 basis point gap between China and Southeast Asia. Now, if we drill into this just a little bit more, we mentioned earlier that there's an interesting peeling apart taking place in terms of the capital dynamics between Indonesia by itself and Southeast Asia, ex-Indonesia. Let's drill into that for a second. Keep focused on this blue line, but what we're going to do in this next page is peel apart the blue line. And when you look at the light blue dotted line, that's Southeast Asia, excluding Indonesia. It's roughly, 55-60% of the region's population. And then the dark dotted blue line below is Southeast Asia, only including Indonesia, 260, 270 million odd people. And what you've seen historically is that Indonesia had a very acute growth equity capital gap vis-a-vis certainly China, but also vis-a-vis the region as a whole. What's really interesting is in the last 2 or 3 quarters, Indonesia has reached parity with China. It's something we see anecdotally, talking to entrepreneurs, looking at investment opportunities in Indonesia. It's sizzling hot right now. Whereas the rest of the region, this light blue dotted line, now has 6 basis points of delta to China and Indonesia, not just 4, which was the historical average. What we draw from this is 2 things. Number one, the regulatory and macro changes taking place in China have caused a lot of investors to look at Indonesia in a new, more positive light. We're seeing this happening in India right now, where the dollar volume of IPOs in India has never been as high in the last year as it's been in recent years. In fact, I think 2021 alone in terms of IPO volume is going to exceed the last several years combined in India. So we are seeing something of a ricochet effect down into Indonesia, into India, because of their size. But the other thing that we draw away from this is how interesting the investment opportunity is in ex-Indonesia, Southeast Asia. And our colleague Petra, who leads our Indonesia office, has done such a great job of highlighting this interesting divergence and dichotomy between, again, Indonesia itself and the region as a whole. And from our perspective, both the blue dotted line and the darker blue dotted line are very important. Indonesian companies, back to our concept of strategy 1, strategy 2, and strategy 3, Indonesian companies are strategy 1. They'll always be an important part of our portfolio and an important part of any investor's portfolio here. But at the same time, one shouldn't neglect the strategy 2 companies, often based in Singapore or KL, that are growing regionally. The Cs, the Grabs, the Carsums, the Red Doorses of this world. So we find a very interesting divergence here, one that we find, I think, very compelling from an investment perspective to keep focused on the blue dotted line and selectively and targetedly to keep looking at companies here in the dark blue dotted line as well. If we think about what that means in terms of big picture evolution of our region, what you see are basically 3 regimes. Roughly until the middle of 2019, there was a very clear funding gap vis-a-vis China. For a brief period of time, kind of Q3 19 to roughly 2Q 20, Southeast Asia very tenuously had a little bit more capital pound for pound on an index basis than China. And ever since then, Southeast Asia has maintained a gap to China of about 4 basis points today, but again, it's divergent. It's 6 basis points in the region ex-Indonesia, and it's arguably 0 basis points in Indonesia itself. This is a very near-term dynamic. We'll keep monitoring it, and we look very much forward to providing an update when we go from our beta report to a full-fledged 2022 report in early 2022 with full year data now in hand. Finally, what we'd like to do as we think about the input side of things before we shift to the output is to give some thought to how to compare Southeast Asia's ecosystem to the rest of Asia. And to do that, we'll look at China, we'll look at India, and we'll look at, of course, Southeast Asia. We'll look at those smaller checks, which we loosely call A and B, but more precisely defined as $1 to $20 million. We'll look at 20 to 100, and we'll look at 100 plus, and we'll look at 2019 pre-COVID in the center of the storm, and 2021, which has been a recovery year across the region. Let's start by looking at 2021 versus 2019. And we've done this on a year-to-date basis of roughly October year-to-date, give or take, for both for China, India, and Southeast Asia. And again, we've isolated it by different tier and size of investments. In China, it's been a great time to be an entrepreneur at all stages. In fact, as the check sizes have increased in size, there's been even more supply. It's reminiscent of, frankly, the dynamics you see with water pipes. Water pipes with very small diameter have high water resistance, and water pipes with very large diameter have lower water resistance. There's a certain fixed cost to getting every deal done, and when the capital spigots are open, as they are globally right now with Federal Reserve policy and other central banks policies, you can see why the larger checks are getting even more growth than the smaller checks, but they're all growing at very, very high rates. India is a little different. India has the same gradient from small check to large check, but it's fair to say that growth for the smallest checks has been flat. And even growth for what we'd loosely call growth equity has been pretty low as well, given that it's a tech industry, but growth for the very largest checks directionally comparable to China. Very, very strong interest in the very largest platforms in India. And in Southeast Asia, we'll first show you the numbers as a whole, and then we'll isolate it as we have before between Indonesia and the rest of Southeast Asia. You see the same gradient taking place in Southeast Asia between small and large, but in a more muted fashion overall to China, and at the high end of our market, lower than both China and India as well. Now, if we compare 2021 versus 2020, basically the pandemic, very challenging year, and now the recovery year, you broadly see a somewhat similar set of dynamics. For example, you see the aspect of the gradient over here from small to large, a little bit less clear of a pattern in India between 2020 and 2021. And again, over here, you see a very nice rise up, in part because the 2020 year was quite challenging for capital, particularly in the growth equity segment in Southeast Asia. Let's look at the countries and slices on an individual basis. In China, this is what it looks like on a 1 to 20 basis. We call these charts cricket charts because they're similar to the runs versus overs depictions you often see when cricket is televised. And you can again see 1 to 20s are up about 30% year to date versus the same period of time in 2020. A similar dynamic again over here for the larger checks in China, up 43% year to date, and a similar dynamic as well, 2021 versus 2020 for the very, very largest checks in China in 2021. India, again, 2021 is up from 2020, but in some ways quite comparable to what 2019 looked like in India at the smallest end. At the mid-size end, comparable to what we focus on, but in Southeast Asia, up 16%. And at the very high end, a very significant increase over 2019 and a relatively meaningful increase as well over 2020 as well. Southeast Asia, 29% up at the small check level, 109% up at the mid check level, but we'll isolate out Indonesia in a second to see how much that drives these numbers, and about 107% up at the very highest end of the scale. So now let's isolate out Indonesia because that's really the story of these last 12 or even sort of 12 months or 3 quarters. What you're seeing on the left-hand side is just the same set of figures from the previous page, 27, 64, and 85. And this is roughly October-ish 2021 versus October-ish 2019. But now let's isolate out Indonesia. Small checks, basically flat. Large checks, up in a reasonable sort of way. But the middle-sized checks in Indonesia, the ones that are often coming from capital rebounding out of North Asia into India and Indonesia, up a massive 171%. That's incredible. Up 171%. That is really dramatic in terms of what's isolated out at the Indonesia level for 20 to $100 million checks. For the rest of Southeast Asia, 34% up on the low end, 100% up on the high end, people investing right before IPOs. But at the middle end, which has actually been the bulk of our bread and butter in Southeast Asia, investing for Asia partners, up only 14%, which is interesting and something that we're keeping a very close eye on. It certainly is interesting from an investor perspective, but can be very frustrating from an entrepreneur perspective because that's very important capital. And in many cases, and we just highlight this as an interesting example, the ultimate winner in Indonesia isn't always the Indonesia company. In some cases it is, but we'd observe that the largest e-commerce company in Indonesia is Shopee, which is Singapore headquartered. Grab is doing extremely well in Indonesia. They're Singapore headquartered. Red Doors is doing very well in Indonesia, Singapore headquartered, which is really speaking to the concept of regional companies, what we call strategy 2. And right now, we would argue there's a real gap in the capital market still. In fact, 14% growth compared to just the tech sector's growth really speaks to the interesting and compelling opportunity that takes place right over here for that strategy 2 kind of company. Finally, we'll do the same set of numbers, isolating out Indonesia for 2021 versus 2020, sort of not skipping over the pandemic year, but looking at it more directly. And those numbers look like this. Again, a huge surge in Indonesia and a much more muted level of growth in the 20 to 100 check for strategy 2 companies. So strategy 1 is a little expensive right now. Strategy 2 is less so. But for strategy 1 companies raising $100 million or above, this is looking very interesting to us, as is this strategy over here, as we look towards the future. Here you'll see the cricket charts as well for Indonesia 1 to 20, Indonesia 20 to 100, and Indonesia 100 plus. And what is so interesting as well, again, is the strategy 2, Southeast Asia ex-Indonesia 1 to 20, 20 to 100, which is really just a tiny bump over 2019 and a little bit more of a return to normalcy versus the very tough year of 2020. And finally, 100 plus for strategy 2 companies in Southeast Asia ex-Indonesia. So that's the current state of play for what we call the input. My co-founder, Peter, has done some great work looking at what all those nutrients turn into in terms of public market value creation on the back end, what we call the output. I think you'll find it very interesting. Over to you, Peter.
Great. Thanks a lot, Nick. Hey, everyone. So now that we've talked about the various inputs that determine tech value creation, let's talk about the various outputs. And when talking about the tech industry, we can generally categorize it to 7 large TMT sectors, which goes from telcos all the way down to traditional media. We had bucketed the sectors this way because we needed a framework that was meant to be generalizable across the world and not only relevant for Southeast Asia. As it turns out, our analysis also points out that there are 3 unique stages in terms of how different countries' tech market cap tends to evolve over time, much of which we found is determined by that country's current income levels. In this case, stage 1 countries include Southeast Asia and China, stage 2 countries include Korea and Taiwan, while stage 3 countries, which are mature growth economies, including Western countries plus Japan. Now, starting off with stage 1 countries in the next page, this graph here represents a chart showing real GDP per capita on the x-axis and overall tech market cap on the y-axis. What you see here for stage 1 countries is that tech market cap tends to stay constant as a percentage of GDP until a certain threshold before it suddenly shoots up. And as it turns out, that threshold is just within that golden age of income band of between 3,500 to 7,000 US dollars. And that is, as we covered, where Southeast Asia is exactly right now, and is exactly where China was about 10 plus years ago. Now, moving on to stage 2 countries, which are moderate growth economies, we see that tech market cap for these rises a lot more proportionally to rising income levels, where tech market cap seems to rise hand in hand with affluence. Last, we move on to stage 3 economies, the most mature growth economies. In this case, using the example of Japan, US, and Canada, we see that tech market cap seems to go more vertical with rising income levels. The reason for this is despite slower income growth in these economies, tech companies continue to become increasingly relevant. Now, putting it all together in the next page, we tend to see that there is a general trend that tech market cap does increase with rising income levels, despite the different nuances across the different models that we just talked about. The only exception to this framework being Latin America on this page. So now that we've established the framework for economies, let's also apply a similar thinking to various sectors. And to do this, let's further categorize the 7 TMT sectors into 3 broader ones. The first is telco, the second is hardware, and the third, all the sectors we can broadly categorize as non-hardware. Now, starting with telco on the next page, we see a very interesting trend, one that for most countries tend to show a somewhat negative correlation or no correlation with rising income levels. As income levels rise, telco market cap as a percentage of GDP tends to stay constant or actually tends to fall over time. And this is especially true for both China and Southeast Asia. In the second slide, we dive deeper into hardware. Interestingly, for hardware, we see a stark contrast with telco. In this case, we see a clear positive correlation between hardware market cap and rising income levels. So this fact is definitely not surprising for hardware-focused economies like Korea, Taiwan, and Japan. But interestingly enough, we also see a similar trend for both China and Southeast Asia as well. Now, moving on to non-hardware, we also see a somewhat positive correlation between non-hardware market cap and income levels. Though what is so exciting about both China and Southeast Asia is that these economies are leapfrogging to Korea, Japan, and Taiwan levels, with online industries perhaps growing in parallel with offline rather than displacing offline, which does raise the tantalizing possibility that perhaps non-hardware in China and Southeast Asia could have a slightly larger percentage of GDP over time just because of their current trajectory. Now, let's dissect non-hardware a little bit further in the next page and dive deeper into internet and e-commerce, which is the sector we are most focused in today. Again, what you see in internet and e-commerce is the same exact point as we saw from non-hardware more broadly, which is this interesting observation that both China and Southeast Asia are leapfrogging other economies. Now, what does all of this analysis mean for us? So back in 2019, we made a prediction that there would be roughly $425 billion in additional market cap that we should expect from 2019 to 2029, which we at that time calculated by comparing tech market cap as a percentage of GDP for Southeast Asia relative to other economies, specifically China. In the next page, we're replicating that analysis with the latest data that we have. And to do this, we run a very simple thought experiment. What would happen if Southeast Asia were to continue on China's trajectory going forward? So now let's look at China's journey, which is the gray dots on this page. As you can see, over time, tech market cap as a percentage of GDP in China may oscillate up and down, but generally they go right and they go up. If we look at Southeast Asia, shown by the blue dots here, we see that it has pretty much followed China quite closely over the past few years. and could very much be following the same trend line. Now, we agree that it's extremely hard to make predictions, especially about the future, but hopefully this and the last few pages that we have just shown enough parallelism between the two regions to show that Southeast Asia could follow a very similar trajectory. Ultimately, what this thought experiment shows is that if it were true, there could be as much as $1.2 trillion in total tech market cap in Southeast Asia by 2031, which is an incremental $770 billion. Now, taking this thought experiment a little bit further, because we have the individual trend lines for each of the large sectors, we could also try to predict where this incremental tech value could come from. Now, as it turns out, it would mean that there is little additional value that we should expect from telco, whereas a lot of additional tech value that we should expect from both hardware, but especially non-hardware over the next 10 years. Hence, from this exercise, if this thought experiment were true, we can come to the following conclusion. Number one, not only Southeast Asia could see an additional $770 billion in additional tech market cap over the next 10 years, but also that if that were the case, it will most likely come from non-hardware, followed by hardware. In a lot of ways, we would expect Southeast Asia's next decade to mirror what has taken place globally, which is a general increase in value creation in technology. What this page shows here is the 30 largest global public companies by market cap in 2011 on the left, and what that looks like today, 10 years later. It's clear from this page that not only is there a significantly higher portion of tech companies amongst the largest companies today, but also that tech companies that were included in 2011 had been excellent in capturing that additional value creation, as seen by the journey of both Microsoft and Alphabet over the 10-year period. Though notice also that the industry mix is changing quite drastically between 2011 to 2021. And we would actually expect this pattern to continue going forward in the future. Hence, we would also forecast that while tech is having a moment right now, we fully expect at least half of the companies on the right-hand side to drop off the list by 2031, which is both eye-opening and also a call to action to think deeply about what the next decade's key investment themes might be. Likewise, just as the US experienced over the past decade, we would expect the lines between tech and non-tech companies to also start to blur in Southeast Asia going forward. Of the top 20 US real estate public companies today, as you see on this page, many of them are either tech-enabled or riding on the back of a particular tech trend. We think that this is very much in the early days of playing out in Southeast Asia, with many of these themes, including data centers, cell phone towers, e-commerce warehouse REITs, likely to emerge as very large opportunity sets in our region. This is a theme we are keeping a close eye on and will continue to study more deeply going forward in the future. So thanks a lot for listening. That concludes our section on the output. With that, let me hand over the mic to my co-founder, Jill, for the next section to talk about an important topic dear to all our hearts, the tragedy of COVID-19 in Southeast Asia. Thank you.
Last but definitely not least, it's important for us to look at the tragedy of COVID-19 and its impact on our region. Before that, however, we would like to express our gratitude once again to the healthcare workers for their tireless efforts throughout the crisis and express our condolences to those who lost their loved ones to the pandemic. In this graph, what you see is the cumulative COVID-19 cases on a logarithmic scale with Southeast Asian countries highlighted in blue. As a general trend, COVID cases as a percentage of the population are converging somewhere between the 1 to 10% band, with Vietnam being the least impacted and Malaysia being the most impacted in the region. Despite the slightly rising trend in COVID cases as a percentage of the population, we are glad to show that vaccination rates are steadily increasing in Southeast Asia. Singapore is leading the charge here with the highest percentage of its population vaccinated, followed by Malaysia. Vietnam is currently behind the pack, but has been quickly catching up. We're also hopeful of the fact that the population of most major cities in Southeast Asia are well vaccinated. In Jakarta, Indonesia, for example, vaccination rates are already approaching 100%. As vaccination rates continue to progress in our region, we're hopeful that COVID-19 will evolve from a pandemic to an endemic in Southeast Asia. Partially thanks to the increasing vaccination rates, mortality rates have also been falling at a steady rate, from 4.4% at its highest in April 2020 to 2.2% as of September 2021. That is not to say that 2.2% is low, as we will always aspire to reach zero, but there is to say that an improvement has been visible, and we are hopeful to have this number continually decrease going forward. We did unfortunately see a spike in the mortality rate in July-August 2021, when the Delta variant plagued the region ravenously, in Indonesia in particular, though we are hopeful to see that trend started to flatten and fall again in the month of September. An interesting way to look at the effect of the pandemic is to look at the retail and recreational footfall across the countries in Southeast Asia. As a result of travel restrictions, most of the countries faced a huge decrease in retail and recreational footfall in the first 3 months of the pandemic, only to have it resume shortly thereafter. The decrease in footfall is typically a measure of how strict the government has been with its lockdowns. From this, it's interesting to see that both Thailand and Indonesia have recovered to its pre-pandemic levels, while some countries, like Vietnam, continue to be drastically affected, even until today. In the same lens, we look at the workplaces footfall across Southeast Asia, and we are pleasantly surprised that Indonesia is already ahead of US in this measure.
Thanks so much, Jill. In addition to being a co-founder and our CFO, Jill is also our ESG officer and is spending time thinking about how we can measure the social impact that we and our portfolio companies are creating. We're very grateful for what each of our companies is doing on this important front, and we're doing our best to be part of the solution in our own social impact work as well. As we bring our 2022 report to an end, we'd like to share a few concluding thoughts. Final thought one, can anyone benefit, even in the near term, from a trade war? Well, trade is a good thing, and trade raises living standards around the world and creates diversity and authenticity of goods and experiences for consumers worldwide. But if you think about what the near-term implications are of the ongoing trade war, which has now persisted through 2 US presidential administrations, what's very interesting is that it's creating trade diversion. And trade diversion seems to be maximized in countries, including many of the countries in Southeast Asia, which is something very interesting to keep an eye on. Vietnam in particular, Malaysia, Singapore, Thailand, even to a certain extent the Philippines are all somewhat beneficiaries of trade diversion away from the US and from China. Likewise, there's an interesting set of findings from Nomura as well around who will benefit from import substitution by the US and China. And there, Malaysia seems to be the highest beneficiary, followed by, in our region, Thailand, the Philippines, Vietnam, Indonesia, even Singapore. And then finally, we can also look at which countries will benefit and which may actually suffer from production relocation away from China. China has the world's workshop and factory for many of the past 20 years. Vietnam is the clear beneficiary over there, followed by Malaysia, followed by Singapore, despite its wage costs, Thailand, the Philippines, and Indonesia. And we didn't just isolate out just the Southeast Asia scores over here. This is the chart that Nomura put together, which says that if there is a near-term set of winners, and there may be no long-term winners, but if there are near-term winners from a trade war, Southeast Asia has some very interesting attributes, including its cost structure and its geographic proximity to the trade lanes that may give it a bit of a lift in the near term. Final thought two, are today's global public equity markets overvalued? We unequivocally come out and say yes. And the reason that we say that is that if you look at a simple ratio that Warren Buffett has favored for many, many years, the ratio of market capitalization to GDP, that ratio on a global basis has not been higher in recent recorded history. If you look at the growth of global market cap, it was roughly 25 trillion in nominal terms in 2003. It is currently over 100, or give or take $120 billion in rough numbers. Global GDP has continued to grow over the past roughly 20 years. And the ratio of current market cap to GDP peaked at 107% right before the global financial crisis, troughed at 42% in the absolute depths of the global financial crisis, and is today even higher than the previous peak at 127%. Now, we'll update this when we issue the final version of our 22 Internet report early next year, but at 127%, we get concerned. You could think of this as almost like the global enterprise value to EBITDA ratio, the global equity value to EBITDA ratio, that sort of apples to orange math even makes any sense. A friend of ours said, well, look, this is the wrong way to look at it. You should actually look at it on a next year's GDP basis because share prices reflect future expectations. He's absolutely right. So here's what that math looks like. Current market cap, global GDP, and we do the same math. We divide it by next year's GDP. Again, the ratio has never been as high in recent memory as it is right now. Another way to look at it is take that overall pattern of global market cap and draw a trend line in terms of how that's evolved over the last roughly 20 odd years, and look for oscillation above and below trend. Now, by definition, as a trend line, it's kind of like the best fit line. So it will oscillate in roughly parallel terms above and below. But what is so striking when we do that assessment of delta above and below trend line is how symmetric it is. October 2007, 49% above trend line. March 2009, 44% off trend line. Here we find ourselves in the depths of COVID last year, 28% off trend line. And now we find ourselves at 28% above trend line. They say in boxing that the bigger they are, the harder they fall. We see numbers like this above trend. And while we can't predict how much further they might go, we can say with some certainty that they do tend to oscillate and whiplash back the other way sooner or later. And as you think about what parts of the world could be potential defensive havens in a correction, in a arguably very significant correction based on where we are right now, it's interesting to look at the 2000 to 2002 dot-com recession. On a global basis, there were very, very few companies that actually managed to generate at least 30% IRRs and had some minimum scale of at least 500 million of market cap at the beginning of the recession. But America was first, followed by China in terms of the number of companies, followed by a number of other countries developed and developing around the world. In the global financial crisis, that roughly 3-year period, China was number one, followed by America. And then you start to see some countries from Southeast Asia like Thailand and Indonesia. We would argue that in what we might predict to be the great crash of 2022 to 24, Southeast Asia might generate some of those companies again as well, which is something very interesting to keep an eye on, as well as other developing markets around the world. No one can say with any precision what this will look like, whether it will even happen in 22 to 24, but we think that a correction is coming, and we're keeping our eyes very closely on it. And as Petra mentioned in his slides earlier in today's conversation, if you look at the top companies by market cap in 2011 and the top companies globally by market cap in 2021, what a dramatic transition there was. Not that many stayed in the top 30 from 2011 to 2021. And it reminds us of the immortal words of Percy Shelley when he said, I met a traveler from an ancient land who said, 2 vast and trunkless legs of stone stand in the desert. Near them on the sand, half sunk, a shattered visage lies, whose frown and wrinkled lip and sneer of cold command tell that its sculptor well those passions read, which yet survive, stamped on those lifeless things, the hand that mocked them and the heart that fed. And on the pedestal, these words appear. My name is Ozymandias, King of Kings. Look on my works, ye mighty, and despair. Nothing beside remains. Round the decay of that colossal wreck, boundless and bare, the lone and level sands stretch far away. We're not trying to depress you by quoting Ozymandias to you, but simply to highlight that the companies that are magnificently large today, some of them will continue to be the world's 30 largest public companies in 10 years' time, but many will not. It's a persistent feature of capitalism, and it's hard to believe in any one month or year that can possibly happen. Look upon me, my works, ye mighty, and despair. But the more permanent part of the poem is that the lone and level sands stretch far away. So as we look at these companies from 2021 versus 2011, mark our words, in 2031, there'll be a lot of new names on this list. We hope some of them will be from Southeast Asia, but more broadly, there'll be a whole lot of new names on this list. And I think it really excites us as investors to give some thought to what themes, what regions, what kinds of business models will generate those next companies that will emerge on this list in the years to come. Which brings us to our final thought in praise of capital productivity. Inasmuch as there's tremendous disruption of who the top 30 are over long periods of time, one thing is true. The ultimate test of skill and of survival is the fact that about 70% of the most successful internet and software companies in the world spent less than $100 million to get to cash flow break even. And we feel a real need to accentuate and highlight this point in a time when capital in some parts of the world is plentiful. And when entrepreneurs are perhaps less focused on capital productivity than on raising the next round. The entrepreneurs that we love backing, and you can see 6 of them in our portfolio so far, take this perspective deeply to heart. They are focused on multiplying their share price, not just on the headline, top line valuation of their company. And the data points are as true today as they were when we first shared this about a year ago, which is that 70% of the 40 or so largest internet and software companies around the world had a fairly minimal amount of cash burn, to the point where operating cash flow less CapEx flipped positive. And that is just such a powerful theme for the long run. It partly perhaps explains how so many great companies get born during recessions, because when capital is scarce, you have to be more skillful. You have to find a way to turn a nickel into a dollar and build a business out of whole cloth. And that dynamic is what yields share price accretion over the long haul. And those companies, we believe, to Ozymandias' point, end up being the longer term survivors and the earlier successes over long periods of time. So here's a hats off to all the companies that have this philosophy. We're not big fans of unicorns, but we love rhinos. Companies that get to $1 billion or more in scale on a PE multiple, maximizing the value of the capital resources they've accumulated, and also maximizing the ownership and ultimately the net worth of their founders, because they've been so thoughtful about the way they employ capital and minimize their own dilution. And on that productive and hopefully optimistic note, we'll wish you a very, very happy new year, a very safe and healthy new year ahead for you and your families. And we very much look forward to hosting as many of you as we can when your travels next bring you to Singapore. Just drop us a note if you're coming this way, and it'll be our pleasure to have a meal together. Take good care. Bye-bye.